Welcome to the Deep Dive, and today we're featuring our Talk Tickers segment, where we really get into the details of company earnings calls.
That's right, we cut through the noise.
And today we're tackling JELD-WEN's Q2 2025 earnings, which dropped on August 6th. Now this one definitely turned some heads.
It really did. The market reaction was, well, pretty dramatic, especially given the tough backdrop for housing.
Exactly. So the big question we're digging into is, how does a company with, frankly, falling revenues and negative cash flow see its stock jump, 26% in a day?
Yeah, that's the mystery. It feels counterintuitive on the surface. We need to look past just the headline numbers.
Okay, let's start there, though. The results snapshot. What did they actually report?
All right, so adjusted EPS earnings per share came in at -4 cents, which, okay, is
not usually something to celebrate.
This is the key part. The consensus estimate was way lower, at -11 cents. So they beat that by a solid 7 cents.
Okay. So a beat, even on a negative number. That context is crucial. It wasn't as bad as feared.
Precisely. And then you look at revenue, it was $823.7 million. Again, that beat expectations by about 1.3%.
Okay, another beat, but still down compared to last year.
Oh yeah, significantly down, about 16.5% year over year. So it's not like business is booming, but beating estimates in this market, that sent a signal.
A signal of resilience, maybe, or just better management of expectations.
Probably a bit of both. And adjusted EBITDA landed at $39 million, a 4.7% margin. So yeah, the top and bottom line beats, that's what really got the market's attention initially.
And attention it got. That stock move was something else. Pre-market call, shares were already up like 9%.
Yep, and then by the end of that trading day, a huge 26% surge. It shows how much pessimism was baked in. Any sign of stabilization was going to get rewarded.
Like the market was just waiting for any excuse to believe things might be turning around.
Spot on. It felt less about stellar results and more about, okay, maybe the worst is over, or at least management has a plan.
Right. So let's get into that plan and the details behind the numbers. Financial performance, that 16.5% revenue drop, where did it come from?
Mostly lower core revenues. That means stripping out things like divestitures, looking at the main ongoing business.
And it was broad-based?
Pretty much. They flagged lower volumes across both North America and Europe, which they kind of expected.
Yeah.
Plus the impact of selling off that Towanda facility.
Let's break down those regions. North America.
North America took a bigger hit. Revenue down almost 22% to $555.7 million. Core revenues there fell 15%.
Why such a steep drop there?
Primarily lower volumes reflecting the housing slowdown, but also a bit of negative impact from pricing and productivity. Plus, they mentioned losing some business from a Midwest retailer earlier, and again, that Towanda sale effect lingered.
Okay, so a mix of market and company-specific factors. What about Europe?
Europe held up better, surprisingly. Revenue only down 2.7% to $268.1 million.
How did they manage that?
A couple of things helped offset the volume weakness there. Favorable foreign currency exchange rates, a stronger euro, basically. And they were able to implement some selective price increases.
Interesting divergence, but overall profitability still took a hit, right? Adjusted EBITDA was down quite a bit year over year.
Yeah, down by $46 million. And that really comes down to those lower volumes hitting efficiency, plus what they call negative price cost.
Meaning costs went up faster than prices.
Exactly. Raw materials, production costs, they couldn't pass it all on. Even with their transformation efforts and cost cutting, the lower volumes just made factories less efficient. Management admitted that was a bigger headwind than they had anticipated.
Okay, so tough operating environment. How's the balance sheet looking? Cash flow and debt?
Well, cash flow is still negative for the year so far. They used about $49 million in operating cash flow and about $125 million in free cash flow in the first 6 months.
And they're still spending on fixing the business.
CapEx.
Yep. CapEx was around $76 million year to date, going towards those transformation projects. Which brings us to debt. Leverage. That number stood out.
It did. Net debt leverage climbed to 5.7 times EBITDA. That's high.
Very high.
Yeah.
Did management acknowledge that?
Oh, absolutely.
Yeah.
Explicitly said it's above their target and a top priority. They made a point, though, that it wasn't because they borrowed more money.
It's because the EBITDA part of the ratio went down due to lower volumes and profits.
Precisely. It's a performance-driven increase in leverage, which is, still a problem, but a different kind of problem than just loading up on debt.
Do they have enough cash on hand? Liquidity.
They seem okay for now. Over $130 million in cash,
Yeah.
plus a big $500 million credit line they haven't touched and don't plan to this year. So there's a cushion.
But that leverage number needs to come down. Are they doing anything about it?
They are. This is another key point. They're actively looking at strategic options. Could be selling smaller bits, like the North American distribution business,
Or bigger moves.
or even bigger things, like potentially selling off the entire European operation. They promise clarity on these plans by the end of the year.
Okay, that's significant, a potential major shakeup to fix the balance sheet. That definitely signals intent.
Right. They said they're in the first innings of reviewing options, so not rushing, but definitely looking hard.
Let's shift to management's overall message. CEO William Christensen, what was his tone?
Focused on execution. Disciplined cost cuts. Improving quality, improving service, despite the difficult environment. Trying to control what they can control.
Which sounds sensible, but the real headline grabber was the guidance, wasn't it?
Without a doubt. Reinstating full year 2025 guidance after pulling it in Q1, that was huge for market confidence.
What are they guiding for?
Revenue between $3.2 and $3.4 billion. That still implies core revenue decline, maybe 4% to 9%, so they're not calling for miracle recovery.
Realistic then. And profits.
Adjusted EBITDA between $170 and $200 million. And they expect operating cash flow to be roughly a $10 million use for the full year. Still slightly negative, but much better than the first half run rate.
Just putting that guidance back out there based on better visibility, you can see why the market liked that. It removes a big chunk of uncertainty.
Totally. It suggests management feels they can navigate the rest of the year. And they're continuing the heavy lifting on transformation.
Like closing facilities.
Yep. Footprint rationalization. Closing plants in Iowa and Oregon. Converting one in Texas to a warehouse. They're aiming for $100 million in benefits from these kinds of actions this year.
Are these just temporary cuts or longer-term fixes?
They're presented as structural changes for lasting efficiency. About half the benefit is carryover from last year. Half is new stuff for 2025.
What about external factors like tariffs? Still an issue.
Still a factor. They estimate about a $40 million annualized impact, with maybe $17 million hitting this year's results.
How are we dealing with that?
Pricing actions, customer surcharges. They also noted they don't actually source that much directly from China, less than 1%, which maybe limits their exposure compared to some others.
And are they investing for the future too? Or just cutting?
Investing, too. Mention automation. Specifically, a new automated line at their Garland, Texas door plant that's already showing benefits. So, efficiency through tech as well.
Okay, so what's the big picture outlook? Market dynamics.
Still tough. Demand is soft, especially in North America. Volumes are under pressure across the board.
And pricing.
Pricing pressure is starting to bite, too. They guided to a slight negative price-cost relationship for the second half. So margin pressure might continue.
But you mentioned a silver lining.
Yeah, the rate of volume decline seems to be slowing down. That's often an early sign that things might be bottoming out or at least stabilizing.
Any idea how much of the North American volume drop is the market versus JELD-WEN specific issues?
They estimated roughly 50-50. Half due to the overall housing market slowdown, half due to things like losing that retailer and the Towanda sale.
And Europe? Still weak volumes, but offset by FX and pricing.
That's the picture. Overall, management's message is, yes, it's challenging now, but we're taking action, and we believe in the long-term housing recovery.
Which brings us back full circle. Why the huge positive reaction? Let's crystallize that.
I think number one, absolutely, was reinstating guidance. That signal of confidence and visibility was paramount.
Even if the guidance itself wasn't exactly stellar?
Right. It's the act of guiding again that mattered most after the previous uncertainty. Number two, the revenue beat showed they weren't completely collapsing under pressure. Some resilience.
And number three,
the market is likely looking past the current weak fundamentals and betting on the turnaround story. The cost cuts, the strategic review, the potential deleveraging. They see light at the end of the tunnel, especially if housing eventually recovers.
that JELD-WEN specific turnaround signal seems strong when you compare the stock's performance. You mentioned it crushed the homebuilder ETF.
Yeah, JELD up nearly 75% in 3 months versus about 22% for the XHB ETF. That tells you investors are rewarding the company's specific actions and potential, not just riding a broader sector wave.
Okay, makes sense. Time for our favorite segment. This is not financial advice. Let's get creative. What's an outrageous but plausible trade idea here?
All right. Given the high leverage, that 5.7x number, and management explicitly saying they'll address it with strategic options, potentially involving Europe or distribution, by year-end.
Okay, setting the stage.
How about this? Some of the parts spin off strategic sale play. The core idea is that the market often undervalues companies like this with distinct parts and high debt.
So you're betting they actually do something significant.
Exactly. The pitch is JELD-WEN follows through on their promise and announces a concrete plan by year-end. Maybe they spin off Europe. Maybe they sell the distribution business.
And the impact.
Instant deleveraging. The market hates that debt overhang. Removing it or significantly reducing it could lead to a big re-rating of the remaining core business's value, especially when housing does turn. It forces a reevaluation.
So the specific trade, make it outrageous.
Okay, how about long out-of-the-money call options, expiring maybe Q1 2026?
Whoa. So a leveraged bet that the stock goes way up by early 2026.
Precisely. You're banking on that strategic announcement coming before year-end, the market loving the deleveraging plan, and the stock reacting strongly. The Q1 2026 expiry gives it time to play out.
And the outrageous part is that if the stock doesn't move enough or the announcement doesn't happen or disappoints, those options could expire worthless. High risk, potentially high reward.
That's the nature of the beast. It's plausible because management said they're looking at it and promised clarity. It's outrageous because it requires perfect execution and market reception.
Got it. Okay, let's wrap this up. Key takeaways from JELD-WEN's Q2.
Well, it's clearly a company working through a really tough market.
Yeah.
But they showed disciplined execution, and critically, they put guidance back out there.
That guidance reinstatement plus the revenue beat really changed the narrative and fueled that strong rally. Investors grabbed onto the signs of stabilization.
Definitely. But that high leverage is still the elephant in the room. Management knows it, the market knows it, and the strategic review is now front and center.
The long-term story depends a lot on housing recovering, but JELD-WEN seems to be doing the internal work to be ready for when that happens.
Absolutely. Just remember, everyone, this conversation is purely for informational purposes. It is absolutely not financial advice. Always do your own research.
Couldn't agree more. We hope this deep dive gave you some valuable insights into what drove the reaction to JELD-WEN's earnings.
So the final thought maybe is this. In markets obsessed with macro trends, how much value are we placing, or maybe underplacing, on company-specific actions like aggressive cost-cutting and strategic portfolio moves, especially when leverage is involved? Something to think about.